everyone, and welcome back to this week's Video Insight. Today we're diving into the world of global finance, breaking down an insightful article by Michael Howell from CrossBorder Capital entitled Accord, the most dangerous word in Forex markets. It looks at the global liquidity cycle, its parallels to the 1980s, and what it might mean for investors in 2026. Michael Howell's article kicks off by noting the world is 33 months into a global liquidity upswing. Think of liquidity as the fuel that keeps markets humming. Central banks like the Fed, China and Japan are pumping money into the system to keep economies and markets afloat. But here's the catch. According to Howell, the cycle is starting to look late stage. Rising bond yields, steepening yield curves, tightening credit spreads and firming commodities all point to a maturing cycle. Inflation stirring, and Howell notes equity performance is shifting towards late cycle sectors like energy and materials. Howell draws an interesting parallel to 1986-87, which ended of course with the infamous October 87 stock market crash. Back then, the Plaza Accord, a deal between major economies, sent the US dollar tumbling, much like today's weakening dollar post the so-called Mar-a-Lago Accord. While history doesn't repeat, Howell suggests it can rhyme, and his timeline speculates that early 2026 could be a critical moment in time. The question we all want answered, however, is, are we on track for smooth sailing or is trouble brewing? And this is where it gets what might be described as a little spicy. Howell warns that the US is walking a tightrope between recession and inflation. With huge fiscal demands, new tariffs acting like a tax shock, and a lack of monetary stimulus, the US economy could slow down over the next 6 to 12 months. One of Howell's indicators, which looks at the bond market's term structure, is described as flashing a warning sign of slumping business activity. We recently wrote about China's deflationary trap here at the blog, and Howell also notes China's bond yields are dropping, potentially feeding global slowdown fears. Simultaneously, Europe and Japan are grappling with soaring yields due to massive funding needs. It's a mixed bag, which Howell thinks should be pushing investors toward a more cautious, risk-off mindset. But investors aren't listening. Well, not yet. The S&P 500 and even the ASX 200 and other global indexes are still hitting new highs, but Howell says the gains are narrowing, relying heavily on fresh liquidity inflows. At the moment, there's probably not much to fear. Even Howell points out that global central banks are still adding liquidity, spurred by weak economies and a softer US dollar. China's opening its monetary floodgates to counter US tariffs, and Japan's backing off from tightening. In the US, there's talk of the Trump administration pushing for lower rates and even a new, more compliant chair of the Federal Reserve. It's worth remembering in 1987, rising yields and a falling dollar similarly boxed in the Fed, and when the liquidity party stopped, the market fell. Howell's global liquidity chart shows we're still in an upswing, but the trajectory is slowing. His sine wave overlay suggests we're nearing a peak with a more challenging 6 to 12 months ahead. Investors, he thinks, should stay nimble. Equities shine in an upswing, but as we approach the peak, bonds and defensive assets might start looking more attractive. I'll just counter that by pointing out that central banks have a handy knack, however, of devising new ways to keep the punch flowing. So what can investors do? Those who believe liquidity is the measure to watch should be following what Howell says. And right now, he thinks we're in the very late stages of the upswing, where equities, especially late cycle sectors, still have a little bit of runway, but perhaps in the absence of further stimulus by central banks, will summit that liquidity peak, and after that you might want to start eyeing uncorrelated or deeply undervalued equities and asset classes. Well, that's all we have time for this week. I look forward to chatting with you again next week, and in the meantime, please continue to follow us on Facebook and X.